My name's Steve Bennett, and I lead the direct property business at Charter Hall. Today, I'm going to take you through some of the fundamentals of Australian commercial property investment and how this asset class can fit into your portfolio. So let's start with the basics. What is commercial property investment? Well, in essence, it's about purchasing real estate that generates regular cash flow for investors. The cash flow is generated from leases to tenants that can be private businesses, ASX entities, universities, supermarkets, or government departments, to name just a few. You can access high-quality commercial properties through either listed real estate investment trusts, commonly known as REITs, or also through unlisted property funds. These funds can be invested into by individuals, self-managed super funds or SMSFs, not-for-profit entities, or through companies or trusts. Common commercial property types include office buildings, for example CBD office towers, industrial and logistics facilities, such as warehouses and distribution centres, retail spaces, including shopping centres and social infrastructure assets, such as childcare. So how does commercial property form part of a balanced portfolio strategy? Diversification is key in managing the ups and downs that can be amplified by a single asset class or investment. By including Australian commercial property into a portfolio, you can complement other asset classes and tailor risk levels to suit your own investment goals. You can choose unlisted property investments, listed ones, or simply a mix of both. So what are the benefits of unlisted property funds versus listed real estate investment trusts? Let's start with unlisted property funds, which give you direct exposure to commercial real estate. These are typically less volatile than listed equities and can offer higher levels of income compared to other investment options, such as bonds. Although, it should always be highlighted that different asset classes do come with different risk profiles. What's more, unlisted property has a low correlation to listed investments. So unlisted property funds can offer access to regular, tax-deferred income, plus the potential for capital growth over the long term. There is, however, limited liquidity in unlisted property funds, and investors should be aware that investment terms are usually for around 5 years. Listed real estate investment trusts, or REITs, trade on the ASX, offering enhanced liquidity as well as diversification. They can provide regular income and the opportunity for capital growth. But since they are traded on the stock exchange, they are subject to higher levels of market volatility. Both unlisted property and REITs benefit from the expertise of experienced investment managers who leverage their market networks and exhaustive processes to identify, purchase, or develop institutional-grade properties. So in summary, commercial property can play a key role in diversifying your investment portfolio, whether through unlisted property funds or listed REITs. At Charter Hall, we have over 3 decades of experience in property investment and funds management. We focus on high-quality, well-located assets with top-tier tenants. This enables us to navigate the property cycle while continuing to provide our investors with regular distributions paid either monthly or quarterly. If you'd like to find out more, please visit our website, speak to your financial advisor, or reach out to one of the Charter Hall team. Thank you.